Surging bond yields are creating the perfect storm for mortgage rates. Bond yields are really strong, and we're going to show you exactly how close we are to a very big breakout. We're also going to demonstrate how the fear in the market could multiply the consequences and where mortgages could actually go. The 10-year bond is most likely the biggest story that most of us are just not talking about. These yields have steadily risen from the lows in January of 3.79 to current levels at 4.5%. In fact, the recent swing highs of 4.56 came very close to the very big 5% handle achieved last October. But to fully understand the significance of the 5% high, a break above would put the market at a place we haven't seen in quite a long time. In fact, we have to go back to the July of '07 to see the 10-year Treasury on higher ground. But the uptrend is even more significant than just this. We're still very much in an inverted yield curve condition, and in just a moment, you're going to see how bonds are pricing into the market a significant amount of risk. Again, the 10-year currently sits right around 4.5%, far below the 1-year currently paying 5.13. As we typically expect long-term bonds to pay higher yields than short-term issues, an inverted bond market occurs when the short-term yields exceed their long-term counterparts. In yellow, the 1-year bond steadily remains above the 10-year. Current yields of 5.13 represent an increase from the January lows of 4.65. At the same time, the 10-year is paying a 4.5% yield, which represents an increase from the 3.96 lows achieved at the beginning of the year. By the way, for your information, a basis point is 1/100th of a percentage point. 100 basis points equals 1%. At present, all bond yields have managed gains so far this year, but you're going to see strong bond yields occur alongside a tremendous amount of risk within the financial system. While the 1-year short-term bond is up 34 basis points, the 10-year is up more, rising 62 basis points. Clearly, the 10-year bond is on a rise. While strong bond yields typically coincide with strong economic progress, this creates a whole new problem for us. In short, mortgage rates. To properly explain why this is the case, let's talk about mortgage spreads. A mortgage spread is very simply the average 30-year mortgage minus the 10-year U.S. Treasury yield. So, for example, if the average 30-year mortgage currently stands at 5% and the 10-year Treasury bond pays a 3% yield, the mortgage spread is 2%. Why do mortgage spreads widen? Because of fear. This is from Bankrate. Current spreads match or exceed those historically seen only in times of intense crisis, such as the global financial crash of 2009 and the beginning of the pandemic. During times of crisis, banks will add a premium to the 30-year mortgage to account for the extra risk. In short, mortgage spreads rise as the economy weakens, but weak economies usually occur with declining bond yields. That's not happening here. And that's why our current circumstances are so troubling. We're going to show you exactly how this works in just a moment. Take, for example, the 2008 financial crisis. In blue, the S&P 500 falling in dramatic fashion during the same period of time from lows of 1.4% to highs of 3.1 at the peak. So where do we stand now? As stocks have risen over the past year, mortgage spreads have now declined to a current 225. Historically, over the past several decades, the average mortgage spread is only 1.7%, so the current 225 is still quite high. Let's consider the data. This year, mortgage spreads are fluctuating between 2.4 and 2.6%. During the pandemic, mortgage spreads also traded at these levels. During the 2008 financial crisis, mortgage spreads returned to highs of 2.9. In 1986, spreads exceeded 3%. In fact, in the early 1980s, mortgage spreads rose even above 4%. So what's the risk at the moment? Mortgage spreads currently rest at 225, comprised of the 10-year Treasury bond paying a 463 and a 30-year mortgage at a 688. Remember, we started out discussing the 10-year Treasury flirting with historic highs. What if we see a combination of a 550 10-year Treasury and at the same time Poor economic conditions, which cause mortgage spreads to rise to 3%. We could potentially see mortgage rates in excess of 8.5% or beyond. What makes matters worse is there is a chance the Fed may actually raise rates even further. We recently took a hard look at this possibility and under what conditions this could actually happen. The following will take you through exactly what we uncovered.